Okay, here we go. Hello and welcome everybody to the National Real Estate Post. Obviously, we're here with our friend Barry Habib, and we'll get to Barry in just a second. Thank you, Barry, for saying hi. Before I get started, though, I want to let you know there's two events coming up in February. It's the Diversify and Thrive Summit, where the three powerhouses of your niche providers, this would be Remen with renovation, Angel Oak with non-QM, and Liberty Home Equity Solutions with reverse, all three getting together to do free summits. It's the 5th of February in Houston, the 12th of February in Irvine. There's a banner on the screen here that you can click. It's over on your right, or you could scroll all the way down on your mobile device to find that, or you could just go to diversifyandthrive.com. You can do that to register for it, but you're going to get together and have some free cocktails, of course, afterward, but just a few hours get together and really learn how to make use of all three of these unique products and lenders to diversify your lending portfolio to thrive in this industry, to get more business. So don't miss that. You got to register, though. We got to know how many people are coming. So again, just click the banner over on your right, or there's a link around here somewhere, or just go to diversifyandthrive.com. Don't miss that. February 5th, February 12th. That's going to be a fun one, Barry.
I think so. It sounds like a lot of fun.
Oh, it'll be a great time. They're just great lenders, and they got great products. And of course, it'll be fun to hang out and figure out what's going on. And for those who like the cocktails, to enjoy a few afterward, Hey, let's get right to it, man. You're saying you're not liking what you're seeing right now in mortgage bonds.
Yeah. So we went through a nice stretch, from about December 11th or so into January, pretty much where we went about 3 weeks. Well, we didn't do an alert to lock, and we just kind of rode that puppy up. The technicals were very, very favorable, and we showed a lot of discipline because there was some days where it's down, but we kind of really had some wonderful gains in price. But since then, if you notice, the stock market has started to kind of get its bearings, kind of started to stop the heavy declines which it had seen pretty much throughout the last 4 months or so of 2018. And just a quick side note here, this corresponds exactly with a lot of the issues in the real estate market. So I just want to break this down for a minute. People, I think, underestimate the impact of the stock market on the housing market.
Okay.
And we are now at a level that is an all-time high, that Americans, when you take the percentage of disposable income to invested assets, it is at an all-time high right now. 7 times disposable income is invested in assets. Which means we're very sensitive to downward moves. Look, this is the whole thing Ben Bernanke wanted to do. He said, look, if we can bring interest rates real down through cutting the Fed funds rate and then buying up all the bonds and the treasuries, mortgage bonds and treasuries, so we bring rates way down so that when people like us were to try to put some money in the bank, you're getting like 0.0, ridiculous. You get nothing for it, so you're forced to put it in other assets like the stock market. Well, when people see their portfolio going up, they have more confidence to buy real estate, and that helped the real estate market. But notice what happened. The decline that we had seen in buying interest, the decline that we had seen even in the car sales business, corresponds perfectly to the big drop that we've seen in the stock market. When people look at those statements, or today, you can even look on your phone, right? You pull up what your portfolio is doing almost daily. That hurts your confidence, and that's what we've seen. So now, the good news is the stock market's kind of flattened out, and we're starting to see stock prices or values kind of recover. That's helping the buyer's psyche. We've seen it even very early on with some things like builder sentiment numbers and early indications that the housing market will have a good spring. But as far as interest rates go, now interest rates improved because money came out of the stock market, went into the bond market. So now I think what you're seeing is a little bit of the opposite, and it's starting to weigh on bonds. And I'm worried because what happened just at the tail end of last week was we broke through an important floor of support on bond prices, and that could be problematic for us.
Can you bring up your screen, perhaps, and show us some of that so they can see what that means?
Yep, we'll do that exactly. So let me pull this up right here. And I think what you see here is this is mortgage-backed securities right now first. So you can see here we had these beautiful gains. Look at this, up, up, up. This is pricing.
We don't see it yet.
Oh, you don't see it yet. All righty. Hang on 1 second.
And then that's okay. Grant can edit this piece. So.
Okay, good. Let me just try and do this one more time.
Now we're cooking. We're getting there. Now we got it. Go.
Okay, so you can see here, this is mortgage-backed security pricing. And what I want you to look at here is just take a look at this beautiful rise in prices that we had seen from mid-November, pretty much exactly correlated to when the stock market declined, early November, I should say, up until just the beginning of January.
And just for layman's purposes, when we see a rise like this on the MBS chart here, this means that things are improving, rates are improving. So just
exactly.
Some of the real estate people might not understand that are real estate agents. So that's what I mean.
Exactly. So this is about a 0.75% rise. Improvement in rate based upon about a 300 basis point improvement in price. So that's about 0.75% improvement in rates, meaning rates dropping because prices are getting better. And then you can see how prices kind of flattened out, but they hit this important floor and they stayed there for a couple of weeks almost, where this floor kind of really protected us. And then look, just at the tail end of last week, we broke underneath it. And there's some room to the downside here. So I'm a little bit worried. Now, when we go to confirmation on this, we take a look next at the 10-year Treasury yield. And see what happened to the 10-year Treasury. We broke above this ceiling. Now, this corresponds to rates, right? So the 10-year Treasury yield down, quite a bit, right? A huge drop from like 3.25% to like 2.5%. Again, about a 0.75% drop in rates over a period of time. And those on MBS Highway, we captured just about all of this. We didn't go for any of the head fakes. We kind of just let this thing go and take advantage of that. But now you can see it's kind of bounced and it's trying to edge higher. Friday's move above this first test is not good news. We've got another one coming up here. Watch 2.85 on the 10-year. If we break above that, that could be problematic. This is all being driven by the stock market. Let's take a quick look at the stock market here. And when we take a look at the S&P 500, look at the perfect correlation. The stock market goes down, rates go down. Stock market goes down, the money goes into bonds, mortgage bond prices go up and improve. But look how stocks have been really making a nice move up. As I mentioned, that's good news for your customer, okay? That's good news. They see their portfolios improving, more confidence to buy homes, more confidence to buy cars, and that's what you've seen of late. That's why you've seen a little bit of a rebound in real estate. Now, when you take a look at this level where it is right now, we break above here. If we get a good day on Tuesday and the market opens to the plus side, has an up day on Tuesday, well, that means we broke above this ceiling. What that means is that rates will get worse. So this is the driving factor. This is the catalyst. Watch essentially 2670 on the S&P. We close above 2670, bad news for rates.
Gotcha, man. Good stuff. That's awesome. So, well, obviously, if you're a loan originator, you're going to want to keep close tabs on what's going on. If you don't have MBS Highway, you should have MBS Highway. We'll make sure we put a link down below where you can try it out for a little while for free. And for our real estate partners out there, stay tuned to your mortgage originators to find out what's going on. And so it looks like today, Tuesday, in fact, is kind of the clutch day. So we'll see what's happening and how it transpires. Anything else? We got to wrap this up, but anything else on the rest of the week, other numbers coming in that could even add to the fuel to the fire on this by chance?
Yeah, there are some housing numbers coming out, but they're a bit delayed. And in addition to that, you should know that these days, even data coming out because of this government shutdown, it's not good. That's another good point to mention, by the way. If the government shutdown gets resolved, that could be more fuel to benefit stocks pulling money away from bonds. So watch for things like deal with China, resolve government shutdown. That's going to be good for stocks, bad for bonds. Watch those headlines.
That's great stuff. Barry, appreciate you being here, man. You guys have a great day. Leave us your comments down below. Barry will try and get in there and answer them if he can. He's very, very busy. We know that, but he always likes to try and chime in when he can. Appreciate you being here, brother. Thanks again.
Thank you so much, my man.
You guys have a great day. Do us a favor, forward, share, and subscribe, and we'll catch you later here at the National Real Estate Post.